Hi, everyone, and welcome. We'll get started here shortly. Okay, so welcome to our Florida Home Buying webinar. We're excited to have you join us today to talk about what's happening here in Florida and what steps you can take to purchase your new home in today's market. We got a lineup of 4 different presenters for you today. I'm Hector. I'm an area sales manager here in Central Florida. I entered the new home industry back in 2006, and since day one, the best part of my job has been helping people purchase their very first home. So here's a quick summary of the topics we'll be covering. We'll talk a little bit about Taylor Morrison, who we are, and what makes us unique as a home builder. We'll discuss a market update for Florida. We'll talk about the benefits of owning a home. We'll take a deep dive in the mortgage process. We'll then show you some simple steps on how you can get started on your new home journey. Hopefully, we'll answer many of your questions over the next hour. We'll also open it up at the end for any questions in our chat section. Also, we'll send a link out to everybody on the call that you can use for reference. So let's go ahead and get started. Who is Taylor Morrison? Taylor Morrison has over a 100-year history and has grown to be one of the largest home builders in the nation, building in 20 different markets, coast to coast. We love helping people move into the new home of their dreams and are most proud of the fact that consumers have recognized Taylor Morrison as America's most trusted home builder for the last 7 consecutive years. What's more, we serve every buyer demographic from first-time buyer to move up to active lifestyle. We've also been recognized by Fortune magazine as one of the world's most admired companies. So let's talk a little bit about what's happening here in Florida. Let's start with the basics, supply and demand. You've heard that term before. People want to live in Florida. Up to 1,000 new people move to Florida every single day. Even with 20,000 permits in the last 12 months, we still don't have enough homes for demand. Lack of inventory has attributed to rental payments increasing almost 24% since last year. In addition, when you look at this chart, you can see that interest rates are still below historical averages. As you can see in the 80s, it was much, much higher. Still way below that mark. I believe it's normalizing. It's closer to a 50-year average versus what we've seen over the last few years. So let's talk about the benefits of owning a new home. Some emotional benefits include safety and stability, privacy, my personal favorite, peace of mind with a new home warranty. On the financial side, there's a benefit that real estate typically appreciates slightly higher than inflation. There's stability of a fixed payment without the concern of a rising rent. And of course, mortgage interest is typically tax deductible. So what does your new home look like? Our design experts have curated classic color palettes of soft neutral tones paired with cabinets and flooring that form the design foundation for your finishing touches. Here are the 3 professional design collections from Taylor Morrison's Canvas program that makes designing your home easy and stress-free. And best of all, there's a benefit that you'll know exactly the final price of your new home. So whether it's chatting with our internet home consultant, our community sales managers, or our construction superintendents, we're here to help you every step of the way. But in today's market, perhaps the most important advisor is our mortgage consultant with Taylor Morrison Home Funding. So with that, I'd like to turn it over to Christy Farrow with TMHF team. Christy?
Thank you, Hector. You're too sweet. Good afternoon, everyone, and thanks so much for joining us today. I am excited to be with 2 of my counterparts to go over some basic mortgage foundation qualification information with everyone. Just a little bit to introduce myself. I have been with Taylor Morrison for over 20 years. It is where I have called home the majority of my career. And as crazy as it does sound, mortgage financing is a passion of mine, but it's really centered on being part of the home buying journey with our customers and our builder. We here at Taylor Morrison exist to ensure that our sales teams and our mortgage teams work together to help you and families achieve that dream of home ownership and really have the most seamless experience possible. I currently oversee our Florida region origination team, and I assist nationally with our sales training and marketing initiatives, some of which we are going to be excited to share with you a little bit later in the presentation. So with that, I'm going to kick off our financing portion of today's webinar and give a brief foundation of mortgage qualification. So many of you may agree that the thought of buying a new home is extremely exciting, especially new construction because it's brand new. But the financing part of it can feel daunting and scary. And I'm hoping today that we're able to provide some information that doesn't feel too overwhelming, scratches the surface of some basic qualification guidelines, and may help you point in the right direction to home ownership. If you haven't already owned a home. We could spark more questions or give clarity that you're in a great position to start looking for a home, or you might realize that you're not quite there yet, but you've got the confidence that you're not as far away from that front door as you thought. And we have some resources that can help you. So hopefully we can provide some useful tips and tools. But in addition to basic loan qualification, we're excited to tell you about our qualification improvement arrow, Able, Ready, Own, and also introduce you to Dorothy, which is our mortgage technology platform. And as Hector mentioned, please feel free to put any questions in the chat and we will be responding as any questions come in, and hopefully we'll answer those throughout the presentation. So many of us in the mortgage industry refer to the foundation of loan approval as the 4 C's, quote unquote, of mortgage qualification. My preference, however, is to compare loan qualification to the 4 legs of a chair. I think it's a good visual, and I'll state the obvious that most likely you wouldn't sit in a chair without 4 legs that are sturdy. And as a lender, we want to be sure your loan has those 4 strong legs as well. And it really gives that stability and comfort to move forward. And just considering that as a lender, we are typically lending hundreds of thousands of dollars. So it is important that we understand the value of your property that we're securing the loan against. We also need to understand you have the ability to save funds to purchase your home. You can repay the loan, and whether or not you have the strength in your credit history to pay your debts timely. So we'll touch on each of these individually just to give a general understanding of that mortgage qualification, and then maybe help you discover where you are in that journey to homeownership. So first I'm going to talk about the collateral piece of our 4 C's, which is the appraised value. So when you're securing financing to purchase a home, a lender is going to require an appraisal report, which provides that current value of the property. Appraisals are completed by an unbiased third-party licensed appraiser. Didn't used to be that years ago, but it is now. And so there's really no influence given by the lender or by you, the home buyer. We have to be sure that we're lending appropriately to the value of the home, make sure the home's worth its purchase price and can be sold to cover losses. God forbid a homeowner were to have to default on that mortgage. But most importantly, you want to be sure that you're protected from paying too much for the home and that you are getting fair value. So appraisers conduct deep research of those comparable sales data. They conduct on-site visits, they verify home size, features, conditions. They even take measurements and photos. There's a lot of research done to find recently closed comparable properties that are nearby. And all of that information gets compiled and put into a report that gives value of the home with a real-time selling price. Now, on the rare occasion that an appraised value does come in below purchase price, there are many ways to resolve that through financing. And many times what that means is an increase to the loan to value, and we'll talk about loan to value, which really will have no impact on financing. If there is going to be an impact to financing, those resolutions might include paying upfront mortgage insurance versus having it monthly. You can pay that at closing. Or perhaps the seller offers additional incentives to assist with that cash to close towards closing costs, which helps with that down payment difference. And sometimes a reduced price is done to mirror those past closings, but it isn't always the best option for you as the consumer or the seller. And as a consumer, it really can have like a potential domino effect of a home depreciation throughout the community. Nationally, we have seen home prices appreciate over the last 2 years to historic highs, 9 and 15% annually. And although those rising interest rates that we keep hearing about in the media have slowed down our new and existing home sales in recent months, it is anticipated that home appreciation is really going to level out to historical averages of about 5% per year. So honestly, we really don't expect to see any significant corrections to the market, similar to what some of you may have experienced or heard about back in 2007, 2008. And honestly, it is really due to more prudent lending, giving credit to borrowers who truly can afford to purchase and also hold that strong equity in their homes through down payment. So with that, let's go ahead and move on to our second aspect of loan qualification, which is cash in your down payment. So it is important that we determine and verify cash needed for your down payment, and also that you have the funds to cover closing costs to complete the purchase. And with regard to down payment, the loan you're applying for is going to have a maximum loan to value threshold. So this is where that appraised value comes into play. And your loan to value is that ratio used to determine the amount necessary needed for the down payment. Your maximum loan amount is going to be determined by your sales price or the appraised value, whichever is less. So your minimum down payment is going to vary by loan product and or the occupancy type, whether you're purchasing a primary residence, a vacation home, or perhaps an investment or rental property. So this slide just essentially shows an example of a home price of $300,000, where an appraised value comes in at $310,000. And if you were putting 5% down, it would be 5% of the 300, not the 310. And then consider that when you do close on that home, you've got that instant $10,000 of equity that you just moved into. But there are guidelines that establish where your down payment can come from. And there are acceptable and unacceptable sources. So some of those acceptable sources of down payment would be the obvious: funds from your checking, savings, money market accounts. Deposits, however, into your bank accounts that are not from payroll likely are going to require some sort of paper trail to source where they came from. Investment and retirement accounts sometimes will even allow you to borrow or withdraw funds for the purchase of a primary residence without penalty. Gift funds are very common, and that would be money given from a spouse, child, or another dependent, or by any person who may be related by blood, marriage, adoption, legal guardianship. And if your spouse or domestic partner isn't joining you on the loan, you can also receive a gift from them. There are state and county down payment assistance programs available, but I would always recommend just checking on that local municipality for availability and qualification, because that is a little bit of a separate entity for that piece of down payment. Many times what's beneficial with new construction is you have that space needed to save funds. So we can even complete a budget worksheet, and that would show your ability to save those funds during construction. And could be the difference of whether you purchased a home to close that's completed and ready to close in 30 to 60 days versus that 6 to 9 month time frame or longer to save those funds. And then last, if you do own a current home, you can certainly use proceeds from the sale of another property. And sometimes we will see folks that have personal items like a boat or a car that are sold for down payment, but those do require bills of sale. But again, it's really just about sourcing where that down payment is coming from. And then those unacceptable sources, it's pretty simple: cash on hand. If you keep money in a safe or a safety deposit box, or some people refer to it as mattress money, that is not acceptable. It must be seasoned in a bank account. And then there's credit cards or cash advances from credit cards are not okay because they're not technically considered secured funds. They're considered borrowed. So when it is time to make that decision to move forward, you will be required to provide what's called an earnest money deposit. So when you go to contract, that deposit's required, and it will vary by the market and vary by the community that you purchase in. Taylor Morrison does have required deposits, and like I mentioned, it could vary even down to the loan program. But I would always refer back to one of our community sales managers for more information specific to where you're looking to buy. The earnest money is applied towards your down payment when your home closes. So it's a credit given at closing and goes towards that financing down payment that you've decided to do. And again, providing the proof of that deposit fund is extremely important. So for example, if you purchased a home today and had a $10,000 earnest money deposit, but you aren't closing for 6 months, those bank statements that you use to make that deposit would be required to ensure that there are no non-payroll deposits that need to be sourced, etc. Now, the other piece of your cost for closing is going to be closing costs. And there is what's called interested party contribution. So you can get assistance with that. So the settlement costs associated with buying a home are just that secondary piece for cash needed for closing. Now, I will say in Florida, the closing cost, kind of a rule of thumb, will vary anywhere from 2 to 4% of your purchase price. And that would include your lender fees, your title and settlement fees. We do have government fees and transfer taxes here in the state of Florida. And also you will have your first year of homeowners insurance you pay at closing. Most customers will set up an escrow account for real estate taxes and homeowners insurance. So there's a little cushion set aside. So every month when you make your payment, you're paying towards those for the following year. And Taylor Morrison communities do have homeowners associations. So sometimes there will be startup fees and costs that are related to a particular community that are due at closing. Now, the interested parties that are able to contribute, that would be either the seller, in this case, perhaps Taylor Morrison, your lender, that's us. And if you have a real estate agent you're working with, they certainly can contribute as well. None of these interested parties can contribute towards down payment, but certainly can assist with any costs associated with financing, which we have listed up on the slide. So if a real estate agent contributes a portion of their commissions, we can provide you a credit at closing as well. All of our Taylor Morrison communities do provide a contribution towards financing as an incentive when you finance with Taylor Morrison Home Funding, and then Taylor Morrison Home Funding will double down with a lender credit. There are maximum limitations based on the purchase price of your home. That'll be a percentage. So depending on the loan product, the occupancy type, there are standard guidelines that will put a max contribution on that. Currently, Taylor Morrison is offering some pretty incredible incentives that could cover almost the majority or all of your closing costs. And Hector's going to come circle back around at the end of our presentation and tell you about what we currently have. So with that, let's go ahead and move on to our third leg of our chair, which is capacity. And capacity is going to refer to your ability to repay the mortgage through job stability and or the likelihood of your income continuing. And one thing I want to note is that your mortgage approval is based on gross income, which is going to be income prior to any federal and state taxes taken out. And Alicia is going to talk in a little bit about monthly income and debt and how to understand that maximum spend against the income that you're using for qualification. But when we talk about job stability, rule of thumb, typically 2-year job history in the same line of work, not necessarily the same employer, would be required. And there are exceptions to that. So I'll give an example. If you're a recent graduate, maybe that's entering your career, and you can provide college transcripts to show that you're working in that line of work that was based on your degree, that would be acceptable. If you've had a gap of employment due to maybe a hardship or took some time off for family reasons and you're re-entering the workforce, this could also be considered for qualification. Self-employed or a contract worker receiving 1099 income, typically a 2-year history is required. And then there's income that you might receive from commissions or bonus, overtime. Maybe you have a secondary job. All of those will really need to show a 2-year history and an average of 2-year income. And we have many, many borrowers who are receiving Social Security and pension, whether disabled or perhaps retired, and that can be used. Distributions that you might receive from investment accounts. You just want to make sure there's enough funds that can create that income stream for the next 3 years. And then last, if you choose to use alimony or child support as income, you don't have to. You would be required to provide a divorce decree with 3 years of continued payment with the last 6 months of receipt. So we always would recommend getting advice from a licensed loan consultant before purchasing and pre-qualifying to really understand the income that you're able to use to move forward. But with that, I am going to pause and take a breath and turn over this last part of loan qualification to my friend Deandra so she can talk about credit in our valuable Aero department. Deandra?
Thank you, Christy. Again, my name is Deandra Avalos, and I've been in the mortgage industry for 22 years. Was fortunate enough to find my home with Taylor Morrison 14 years ago. I've worn a few hats within the organization as a mortgage admin, loan processor, and even assisted with sales and closings. But 11 years ago, the opportunity to be a part of Aero was presented to me and I jumped at it. This role allows me to educate buyers on the ins and outs of credit and help guide you to your new front door to achieve your dreams of ownership. Credit is like a thumbprint in its uniqueness. No two customers' credit profiles are the same, and each one tells a story. Credit's also the topic that we typically get the most questions on. When looking at credit scores for a mortgage, we'll pull a tri-merge report, which just means we're going to get a report from all 3 bureaus, Equifax, TransUnion, and Experian. Your credit score gives an overview of your credit risk to a lender, and it's the factor that is used to determine the mortgage rate that you receive, as well as any potential mortgage insurance premiums. So the lower the credit score usually means higher rates. Let's talk a bit more about credit and ways that you can enhance your score to attain the best possible financing. These are the primary factors that make up your credit score. And as you can see, 65% of your credit is going to be based on timely payments and overall credit utilization, how much you owe versus how much available credit you aren't using. Next would be the age of your credit history, followed by new credit, mix of credit types like mortgages, student and car loans, and revolving debt. I'm just going to touch on the differences between a soft and a hard credit pull. Usually that's kind of on the forefront of everybody's mind. There's a lot of myths about credit inquiries, but a soft credit pull doesn't impact your scores. Soft inquiries include things like pre-approved credit cards, checking your own score with the bureaus, and employment verification. A hard inquiry would happen when you directly apply for credit, like when you apply for a credit card, any type of loan, whether that's a student loan, car, personal loan, or even a mortgage. The inquiries will remain on your credit for 2 years and could cause small incremental decreases in your overall score. On average, it's less than 5 points. There's only 14% of consumers that lose more than 10 points because of inquiries, and 89% of that time, inquiries aren't even one of the top 4 factors that are impacting your score. When shopping for big loans, such as mortgages and auto loans, you typically will get incremental dings, if you will, when you're shopping around, but you're covered within a 14 to 45 day time frame of your initial inquiry. So when you pre-apply for a loan with Taylor Morrison Home Funding, we're only going to do a soft credit pull, which provides us 2 of the 3 scores. Once you make the decision to purchase a home and move forward with your formal loan application, that's when the hard inquiry would take place. There's a lot that goes into credit, and it can be overwhelming, which is why Aero is here to help. Taylor Morrison Home Funding has a department designated to help buyers with qualification improvement and loan enhancement. Arrow, again, able, ready, own. At Arrow, we offer you a personalized strategy to help enhance your credit and provide you with the guidance and education to get you on the right path. Arrow isn't only for those of you that are looking to qualify, it's also great for those with pretty good credit that just want to work towards higher scores, which would benefit you when you're looking at your rate and mortgage insurance. Arrow is a complimentary service for those of you that are looking to buy, and our Arrow consultants will work with you to tailor a path specific to your needs. After you pre-qualify with Taylor Morrison Home Funding, the loan consultant will enroll you in our Arrow program, where we will run credit simulations based off of that credit report and provide you with a personalized improvement path based on your needs and goals. Arrow isn't classic credit repair, so we won't be speaking directly with your creditors or be able to negotiate debts on your behalf. What we will do is provide you with a guidance or a game plan that you actively work on during your enrollment to complete and become an Arrow graduate. Some of the examples of Arrow recommendations would be to open a new account or to be removed as an authorized user, sometimes even added, pay off accounts or reduce balances on existing accounts. Our Arrow consultants are familiar with your financial profile, so we work hand in hand with your loan consultant and Taylor Morrison to ensure we aren't making recommendations that would keep you from being able to purchase, like using your down payment to pay off debt. We engage with you and we assist in keeping you focused and on task with open communication by phone or email, whichever is your preference. Arrow's helped over 4,800 families gain score enhancement and achieve their dream of home ownership. This just kind of gives you an idea of the number of families that we've been able to help over the last 12 months. Our hope is that you see the value of Taylor Morrison Home Funding and Arrow, and that we get the opportunity to work with you next. With that, I will transfer this over to Miss Alicia.
Well, thank you, Deandra, and good afternoon, everyone. I am Alicia Masser, and I have been with Taylor Morrison since 2014 and have over 23 years of mortgage industry experience. I personally oversee the Orlando and Jacksonville loan origination teams, and am extremely passionate about mortgage financing and helping customers just like you achieve home ownership. So Christy and Deandra, they've covered the basic loan qualification criteria. They've provided some tips on credit score enhancements. So now I want to take a few moments, you guys, and really explore the most common loan products, including overall features and benefits. Now, this slide does contain a lot of information, but we will most definitely send this out to you following this call. So let's now start with a conventional loan. A conventional loan is a non-government loan and truly the most common mortgage product. There is the typical expected down payment of 20%. However, you can put down as little as 5%. There's even conventional loans that are specific to first-time home buyers with only a 3% minimum down payment requirement. Now moving on to our FHA and VA loans, these are loans established by our government agencies. A VA loan is an excellent product for any active duty or veteran military service member. There's literally little to no down payment required, flexibility with higher debt to income requirements, and a lower minimum credit score compared to the conventional loans. Now, an FHA loan is secured by the Federal Housing Administration. This one only requires 3.5% down. This one is considered, right, typical for a first-time home buyer. However, a common myth is that FHA loan is only for a first-time home buyer, but it's absolutely not the case. The only caveat with FHA financing is there are loan amount restrictions based on the county loan limits. However, there's more flexibility when it comes to debt ratio requirements and credit score requirements, similar to that of the VA loan. Here at Taylor Morrison and Taylor Morrison Home Funding, nearly 20% of all our mortgage closings are FHA and VA loans. All right, so let's talk housing payment, right? What makes up a total housing payment? There are basically 5 key components: principal and interest, property taxes, homeowners insurance, mortgage insurance, if it's applicable to your loan product, as well as homeowners association dues or HOA dues, which are paid separately to an association versus the lender. But all of these make up a total housing. So we've mentioned debt to income ratio a couple of times now. It's definitely a very critical piece of your loan approval. Overall, your debt to income ratio truly tells the lender how much you can afford. The debt ratio calculation compares how much you owe monthly against how much you earn. When looking at your gross pre-tax income, the lender wants to be certain that after paying your mortgage and credit obligations, you have money left over to pay all of your other expenses, right? So these include your federal and state income taxes, your basic needs like food, clothing, childcare, utilities. You know, and it's kind of been a solid rule of thumb is to not have your housing and monthly credit expenses be above 40% of your gross income. However, there are loan programs that will allow higher than a 50% debt to income ratio to be considered for mortgage qualification. Just like we spoke about on the previous slide, this pertains to FHA and VA financing. But in these particular instances, especially when you go over or up to 50% plus, you want to typically have strong compensating factors, right? Good credit history, cash reserves in the bank. There's a lot of different debt to income ratio requirements based on the loan products. Now, if you wanted to try, right, with this math that is here, if you wanted to calculate your own debt to income ratio, all you would need to consider is your proposed new housing payment and only your monthly credit expenses. Your housing payment, of course, includes principal interest, homeowners insurance, real estate taxes, mortgage insurance, and HOA dues. You would then add to that your minimum monthly payments that are reported on your credit report. Once you add those together, simply divide that amount by your gross pre-tax monthly income. And a rule, like I always remember this as a formula of the little number divided by the big number, which equates to total expenses divided by gross income. That's what determines a debt to income ratio. So at Taylor Morrison, we truly understand that purchasing a home is not something that happens often in someone's lifetime. This is both a financial and an emotional commitment, and likely the largest purchase anyone will ever make. So it's very important that everyone knows that we're here for you and able to help guide you every step of the way. As we wrapped up some basic mortgage qualification, I now want to introduce you to Dorothy. Yes, just like Dorothy from The Wizard of Oz. Our Dorothy is here to help lead you down the path, your personal yellow brick road, and provide you state-of-the-art secure mortgage technology. Our Dorothy also works alongside our Taylor Morrison home funding team to bring you the utmost superior home financing experience by coupling technology with the much needed personal touch service. With the protection of our industry standard encryption technology, I can assure you, you can trust our Dorothy with anytime, anywhere, account access, and secure document transfer alongside real-time loan information. All right, who's ready to get started? So whether you're ready to pre-apply, possibly considering Aero services, or just simply want to talk to a mortgage professional, you can get started by going to taylormorrison.com/home-financing. If you are seeking Aero counseling, as Deandra covered, you can get started with one of our professional loan consultants who can run a credit simulator for you and then connect you with one of our Aero consultants. They will create the right path towards purchasing a new home. Now, if you want to pre-apply for financing, gather some details on what you would qualify for, simply go to the Start Your Journey tab right at the top of the page, select your area and community of interest, and then you'll be prompted through some very, very customer-friendly finance interview questions. Once you do submit your request, one of our local loan consultants will be in touch with you very, very soon. And don't forget, when applying online, we only look at that soft credit inquiry at initial pre-application. So a hard credit pull or a hard inquiry is only needed for Aero credit simulation or for a formal loan application after you have purchased a home with Taylor Morrison. Also, if you just have general questions and want to talk to someone at Taylor Morrison Home Funding, you can click on the Talk to Us tab. That then will send an email to our local loan consultant team, and you should hear from a team member within just a few business hours and very, very quickly. We are definitely here to help. So with that being said, we are so grateful for all of you that were able to join us today. And I truly hope everyone found the mortgage content beneficial. Thank you to Christy and Deandra working together. We appreciate your attendance. Thank you, and back over to Hector.
Hi, everyone. So when I first entered the business in 2006, you had to do a lot of driving. We had the internet, but it was pretty much general information. Now it's really easy. You can search on your phone like me. I do everything from my phone or from the comfort of your home. We have digital tools to help you in your home buying journey. So it all begins on our website, taylormorrison.com. Simply select the area, then the community closest to your desired location. And from the community page, you have all the information to get you started. This includes contact information, driving directions, the ability to schedule an appointment, and request more information. You can even reserve a home right from the website with our online system. From our website, you can schedule a virtual or in-person visit with one of our community sales managers to ensure your time is uninterrupted. Don't forget, let us know if you're working with a real estate agent. Very important. Also, questions about payments and closing costs, our mortgage experts are here to help you with your pre-qualification. And lastly, don't forget, we've been named America's most trusted home builder for 7 consecutive years. Ask us, we're here to help. In both Jacksonville and Orlando, we have homes available for quick move-in before year end. All of these are ready to go with beautiful color packages selected by our design experts. They also include washer, dryer, refrigerator, and blinds to make your experience turnkey. We're currently offering $35,000 worth, we're currently offering up to $35,000 of financing incentives that are flexible to fit your needs. Whether your needs are for closing costs or to reduce your monthly mortgage payment, we can customize the incentive just for you. Christy, do you want to discuss this a little bit?
Oh, I would love to. Sorry, Hector, I think I was on mute for a little too long. Thank you. You know, Hector, it's just so interesting as we move through these times and we saw rates rise as quickly as they have in historic times. But I really love the way that Taylor Morrison has done a pivot on how we are going to help customers still achieve home ownership, because affordability is obviously huge. And it's always a gut reaction to feel like home prices are too high or they've increased too quickly, and maybe you missed an opportunity to buy. But we truly can just put pen to paper here and really show why price reduction is not really going to give that full achievement of home ownership. And when you can take those same dollars as we show here and utilize those towards a financial savings, it is incredible that even by purchasing at a higher price and borrowing more money, the number one most important thing to a new customer is payment. Number two, we know, is cash out of pocket. And with the incentives that Taylor Morrison is offering right now, to be able to layer those incentives tailored to suit the need of a home buyer is really what we're able to do. And again, we will be having this sent out to everybody and you can do the stare and compare, but appreciating that these funds can be used towards closing costs, which we talked extensively about. If this is going to be a long-term financial investment for you, you have the ability to use those funds to permanently buy down your interest rate and essentially roll back the interest rate to where they were late 2021, early 2022. A really unique loan product is a temporary buy down, and that's somewhat of what's displayed here on this infographic. But a temporary buy down is sometimes thought that it's an adjustable rate mortgage, and it's anything but that. It is actually a fixed rate mortgage where Taylor Morrison is going to utilize a portion of those incentive funds and subsidize a payment for up to 2 years and get you that ease into home ownership feel. Many times we see customers that are saving and saving to get that 20% down for conventional financing and avoid mortgage insurance, but mortgage insurance has some creative ways to work around it. And one of those is paying the premium up front. And again, that's something that can be offered through these incentive funds. We are also able to collect up to 1 year of your homeowners association dues. So if you're looking at one of our townhome communities, we can collect up to 1 year. Sometimes those HOA dues are, you know, a little bit more expensive than our single families. So that gives you a benefit there as well. And if you're looking to purchase new construction and you've got quite a few months before your home is going to be completed, if you're ready to secure today's interest rates with the ability to float down as you get closer to closing, we have long-term rate locks available. And I think on the next slide, we just have an example of one of our communities in Jacksonville, one of them here in Orlando, just giving that example of, you know, low payments starting. Honestly, we've done the research and it's below the surrounding market rent. And then also getting an even lower for those first 2 years through that temporary buy down or absorbing your homeowners association dues for the first year. So it just shouldn't be discounted, Hector, you know, what we're able to do in comparison to just always trying to achieve the lowest price. These funds are really honestly in the best interest of the consumer, as well as protecting the values of our community and home appreciation moving forward. So Hector, if you want to close us out, I'm going to just really quick reiterate what Alicia said in reference to mortgage. Please don't hesitate to reach out to a loan consultant team if you have any questions. But Hector, I think these two online email addresses also serve well, correct?
That's correct. We want to thank everybody for their time today. If you have any additional questions, please email orlandoonline@taylormorrison.com or jacksonvilleonline@taylormorrison.com, and we'll be happy to answer those for you. Thank you.
Thank you. Have a great day.
Thank you, everyone.